Joining us from Los Angeles to break down the situation is Donald Straszheim, the Senior Managing Director at ISI Group. Donald, welcome back to Bloomberg Television. Always good to have you on.
Mark, good. Nice to be with you.
Thank you, sir. The news that I just mentioned, China's banking regulator setting that capital target for the 5 biggest lenders above the 11.5% ratio. Could I get your thoughts on that?
Sure, Mark. First of all, China's banks are state-owned enterprises. They're really arms of the Ministry of Finance, have been ever since they were created 20 years ago. They do the government's business. China has an inflation problem. Which they're trying to fight. They have a massive foreign inflow problem of money fleeing zero interest rates around the world and seeking an appreciating currency.
Right.
All of that centers in the banking sector. That's what they're trying to address, and they're trying to protect themselves from these kinds of upsets.
Well, if the Chinese slow down their engine of growth, how might that affect the U.S. economy?
Well, first of all, China is trying to slow its growth rate down. Not a lot, a little bit, from, say, the 10% range of the last few years to the 8 to 9% range. I think they will be essentially successful at that. That is rounding error. If it were to slow to 5 or 6%, that would have a significant slowdown knock-on effect in the U.S. I don't think that's going to happen, but that is what some investors are worried about.
Yeah, Don, can China have price stability without threatening its economic growth?
I think they can, but they've got to be more serious than they have been so far. There have been an awful lot of these little anecdotal price control kinds of measures, which are just kind of window dressing sorts of things that look good but don't have any real effect. They simply have got to rein in their credit growth and monetary growth, which is what they're trying to do. It's taking some time, longer than they thought, but it is beginning to work.
China's benchmark interest rate standing right now at over 5.5%. Is China's central bank inclined to raise that rate anytime soon, do you think?
I think they will. They're doing two things. They're raising the required reserve ratio, which is the reserves that the banks must hold with the central bank. That's their first line of defense. And the second is raising interest rates. And they've raised rates a couple times already this year. We think there are 4 more 25 basis point increases coming between now and the end of the third quarter.
Right.
But the issue with that is that the higher those rates go, it attracts even more capital from abroad, and that's the kind of tight spot that they find themselves in.
Well, if the price of oil continues to rise, how's that going to increase the risk of inflation in China? We're already seeing Chinese stocks at a 3-week low.
It raises the inflation problem in China just like it does here. The Chinese use a lot of oil. They import more than half of the oil that they use. It pipelines through into their prices. One of the things that they try to do is hold down prices administratively, which really doesn't do much good in the long term. But it is raising their inflation rate, and that's why they're trying to address the problem as best they can.
Well, food makes up about 1/3 of China's consumer price index, and the cost of meat, eggs, vegetables, that's high because the minimum grain purchase price was raised. What does this mean for the Chinese consumer?
Consumer prices are going to continue to rise. They're up about 5.4% as of the most recent reading, March. We think that that year-over-year inflation number is going to stay in the 5% range for the next several months. But if agricultural soft commodity prices decline later in the year, as I think they will, China will see some relief, and that will be better news for China's consumers. And there is a massive consumer market in China, and a even more rapidly growing luxury segment thereof.
Don, you follow electricity consumption as a way to gauge the Chinese economy. What's the amount of consumption telling you right now?
It's telling us that China's economy continues to grow at a quite rapid rate, somewhere in this 8 to 9% range. I think that's a good number. That's kind of what we would like to see. We don't want to see it slow down too much.
Yeah.
It needs to slow down some, and that's where that's exactly where the electricity numbers are.
Down in our last 30 seconds, Century Weekly magazine, citing unidentified people, reports China plans to set up new funds to invest in energy and precious metals. That speculation apparently led to gold and silver prices rising to records today. Is China trying to diversify its foreign exchange reserves?
There is an enormous diversification effort underway. They don't want to keep accumulating paper from America, from Europe, from the UK, from Japan. What they want to accumulate is real assets, real companies, technology, management, minerals, mining rights, and all the rest from around the world. It's an important global diversification strategy. It will work, and they're going about it quite aggressively.
Donald Straszheim, the head of China research at ISI, joining us from Los Angeles. Always a pleasure to have you on. Thanks so much.